All right, I'm going to make the case for a potential trade related to the overnight rate of where we expect it to be at the end of the year, what the Fed is saying it's going to be, and why this might be a low risk trade. Again, this is not financial advice. This is just my theory. This is my belief that I think the Fed funds rate could drop lower than what the Fed is saying. Now, it is a little bit of a gamble, but there is a lot of economic uncertainty and there's a lot of geopolitical risk today. So if something were to happen, the Fed funds rate would drop significantly, or it'll stay the same, which means that it would be a low risk trade if you were to take a long position. So let me just set it up for you. Here's the Fed funds rate. This is going back to 1990s. And you can see that the Fed funds rate in white, and you can see that every time before a recession, they had to drop the rates. You don't actually see the recessions here, but we know there was one in 01, there was one in 07, 08, there was COVID, and then, what's going to be here in the future. So the 3-month to the 10-year curve was inverted, and every time it inverts since the 1960s, meaning the 3-month rate paid more than the 10-year rate, because the market controls the long end of the curve like the 10-year, and the 3-month really ties close to the overnight rate, and the Fed only changes just the overnight rate. So when they talk about dropping rates, they're talking about just the overnight rate, and the overnight rate only. So when the 10-year is paying less, that's called an inverted yield curve. And I've got that plotted out here, the zero line there in light gray. And anytime that inverted, it goes below zero. Anytime that happened, it always precedes a recession since the 1960s. So you have it here, you have it here. The Fed sees the recession, they have to drop rates, and you can see they drop rates very quickly. And then COVID, there it is. It was preceded COVID, but it was COVID that caused the recession. But there were probably other things that were happening anyways, even pre-COVID, that were leading up to a recession. It was just, that was the catalyst, that was the event that just caused it to happen. And then look at this inversion here. Going back to July, I believe it was July of 22 that it actually inverted. Sorry, that about the October, November, that was the 3-month. The 2-year actually inverted previous. The 2-year paid more than the 10-year. Started in July of 22. This was this way for 2 years. Long time. This is actually one of the longest in history. But we haven't had a recession yet. The economy remains strong. Or is it? And there may be some underlying data that might show some things a little bit differently. So let me jump into that. So taking a look, I'm just going to highlight just a couple of things. First, I want to show you what initial claims looks like. So initial claims, every time somebody goes to the unemployment office, it's tracked across the United States. That they represent that number every week. It's called initial claims. It was the initial claim for unemployment. And this is only going back a year and a half or so. And you can see that it was declining. And at the beginning of the year, it's been rising. And we're back up to that 240,000 range. So 240,000 people a week are going to the office to file for claim. So you can see your 4-week average is up. Initial claims are up. This would be a pre-read into, since we get this every week, this is a pre-read to the actual unemployment report. This number needs to get to probably around the 260, 275 range in order for unemployment number to the unemployment rate, the 4.2% that it is today, to start going up higher. So that's about the number that you want, because you're going to have a lot of factors involved, but usually around 275 is the neutral point. The other interesting fact that is not showing up yet in the unemployment report is look at continuing claims. These are people who are still on unemployment. It's taking longer to find a job, and they're still on unemployment. And this is really, really pretty high. So it's about 2 million a week. Now, let's look at jobs reports. So this is the jobs ad from the non-farm payrolls that you see every month. That's printed on the first Friday of every month. The jobs ad, that's also going down. So this goes back to 2021. And you can see post-recession, it's definitely a lot of jobs ad. You're talking 900,000 people a month. But then slowly starts getting back to normal. A couple of years ago, we're in that 300, 200 range. And now we're down to 139. What's interesting, though, is the last several months of unemployment reports, the number keeps getting revised lower. So you can see the number is 139 for this one. But as new data comes in a couple of months, they'll most likely revise that lower. So it may not be as strong as they think. The last 2 months, they lowered it for a combined total of 95,000 jobs that weren't added that were previously reported. So that's an interesting indicator that things are weakening. People aren't hiring as much. And if you look at the news, Microsoft just announced that they were going to have a big layoff due to AI. So there's other companies like that. And if you just do a quick Google search, layoffs in the last week, layoffs in the last month, and you see that the layoff numbers are definitely starting to add up, and it'll take time. And in addition to that, the government isn't adding any jobs. Last year, they were adding at a rate of about 40,000 a month. This year, they haven't added any. Starting in January 2025, the percentage change of government jobs added, 0. Now, as you have layoffs and you have the buyouts and whatnot, that's not reported in unemployment yet. That won't get reported until probably later this fall, September or October timeframe is when that gets reported, because they were paid like an 8-month stipend to give them a chance to find other employment. But this is just job ads. So the government is not hiring. Retail has fallen off, so that might indicate that people aren't shopping as much. And if you look at retail sales from last week, that was negative 0.9% month over month. So that is true. Manufacturing, we know manufacturing is slowing. You've been looking at if you look at the ISM, PMI reports, those are slowing. Manufacturing is slowing. Construction's up. That's great. All private employment is up overall. However, it's not up that much. It's only up 0.37. So these are, again, jobs added month over month. Transportation is down. Sometimes transportation, you'd have to keep an eye on this. Transportation is usually a bellwether. People aren't shopping as much. Items aren't being shipped across the country as much. So when you see layoffs in this category, that's a bellwether. Leisure and hospitality, that's a good sign for people dining out and having fun. And then you've got temporary workers. Look at how far year over year growth is down quite a bit. 1.32%. I say quite a bit. It's just down. So that is also could be a precursor, because who are you going to lay off first? You're going to lay off your temporary workers, and then it comes time to the permanent workers. Inflation. The inflation job is done. Everybody talking about tariffs potentially causing inflation. No, it'll cause a one-time price bump, but it does not cause inflation over time. In fact, I would argue that it's deflationary, because things actually deflate because people are not spending as much because things are getting more expensive. As tariffs are passed on to the consumer, people will look for alternatives. And that's the hope, is that they look for alternatives, but it doesn't really drive inflation. There's a lot of arguments around that. I personally don't believe it drives inflation. Inflation is a year over year increase in the prices. While yes, that when the tariff goes into effect, it is a bump. And so that would be a year over year increase. But then the year over year increases in the months following will continue down this path, as you've seen here. One, the Fed funds rate is restrictive. They acknowledge that it's restrictive. They just want to make sure that it's done. They don't want to relive the 1970s. I've got it broken down in a couple of places here, but there's inflation almost 2%, and this is what they call headline inflation. So that's everything including food and energy. And then the other component is shelter. And in another video, I'll show you this one, but shelter makes up 36% of inflation. If you were to break that apart, there's owner's equivalent rent and then actual rent. Owner's equivalent rent is what people think they can get for rent. So it is a little bit based on expectations. 36% for shelter all in, but the owner's equivalent rent represents 26%. So when that reality sets in, you can see shelter follows inflation by about 16 to 18 months. Once that catches up, we're at about 4% inflation year over year for shelter. Again, once that catches up and gets down to that 3% mark, you're going to see inflation drop even further. That's why I think it's time to still go ahead and start lowering rates. But the Fed wants to wait. So this is the what they call the dot plot. This is just in table form. I have the dot plot a little bit further below, but first I want to show you this is the expectation for the end of the year, where they expect the rate to be 3.9. Now in March, they also said it was 3.9, so no changes. This came out just a couple of days ago, June 18th. This is what they think the change in real GDP is. So 1.4, they had 1.7, so they think GDP is going to come in slower. Unemployment rate's going to come in a little bit higher. And then PCE is going to come in a little bit higher. This is their preferred gauge, not CPI, but it's a close proxy. This is all governors where they think the rate will be. They vote before they actually meet. But this is the 3.9 that they put on the dot plot. So they're just taking like a consensus of the whole group, and they said 3.9. So that said, this is the Fed Watch tool. This is based on the Fed Funds Futures, which is what I am trading. And in July, there's a 91% chance based on the Fed Funds price, a 91% chance that they won't change the rate. But first expectation is here in September. So these are the meeting dates. This is the rate. This is the overnight rate. And then what meeting they expect, what's the probability of the rate being in this spot at that meeting. That just implies what the market thinks when the Fed will be cutting rates. So at this point, there's a 58% chance that they're cutting rates on September 17th. And then the next one is in December. This is derived from this. So if you look up here to ZQZ, ZQU, that is a tradable instrument. This is the Fed Funds Future. And so what they're doing is they're taking the 100 minus R, 95.75. You can see it's 4.25. So in September, they're saying the rate will be 4.25, and right now it's 4.5. That's the high end. And then in December, 96.09. If you take 100 minus R, and 100 minus this is 3.905. So it is in parity. It's in lockstep with what the Fed just said. That's what you would expect. You would expect that when the Fed comes out, then the Fed Funds Futures are going to track with that. So anytime that this instrument here goes lower for the December contract, if this goes lower, 96.09, and it goes to say 96, that's definitely a possible trade, because then it's saying the market is saying they don't think the Fed's going to cut as much. But if the Fed says, hey, I'm going to cut to 3.9, which if you just take 4.33, which is what it is today, that's the center, and you minus, because they're cutting 25 basis points increments, if they cut twice, that's 3.83. So that in December will be roughly where it's at, 3.83 or 96.17, because it's 100 minus 3.83. Okay, so this would become 96.17 if they cut twice. If it goes to 96, that might be a better chance of a trade, because of what are the odds that it's going to go lower than that. The Fed's going to need to see some really good data in order for them not to cut rates. With the tariff unknowns and geopolitical risk, what are the odds that the Fed is going to raise rates or not cut as much? So with that, I'm willing to take that bet. I'm willing to say, hey, I will buy ZQZ at what they currently say, which is 3.9. The inverse of that is 96.1. I will take that bet, because if I am wrong and they only cut twice, we know it's going to go to 96.17 because it's 3.83. If they cut twice for 50 basis points, we just did the math on that. So really, I have a low risk trade. If the data comes in solid, geopolitical risk abate, tariffs don't have any effect at all, maybe they don't cut, I'm willing to take that gamble. I think there's higher geopolitical risk, and it's still with the tariff uncertainty, plus unemployment already coming down, the effects of AI on unemployment, the jobs already done with inflation. Why wouldn't I take this trade? So with that, let's jump into Thinkorswim, and I'll show you how to place the trade. So there's ZQZ. ZQZ25 is a futures contract, so you have to have a futures enabled account. You can see currently it's trading now at 96.08 and 96.085. That is 3.92. So the market currently believes that the chances of a rate cut diminished ever so slightly from when I put the slides together yesterday. So it'll ebb and flow. It'll ebb and flow a couple of basis points. That's fine. This is what I'm doing, is I am putting a trade in at, I bought some at 96.08, 96.085. I have a few contracts, and the expectation is that this will at least go to 96.17. And if there's any change in the data, unemployment, jobs add, for example, goes down lower than they expect, something big happens with geopolitical risk, the tariffs create more deflation, which I think they will. They're going to have that one-time price jump, and then they'll drop. Then this should increase. And if I'm wrong, no harm, no foul. The Fed said they're going to cut twice anyways, and it's already at the twice mark. The only way I lose is if the Fed doesn't cut. So why wouldn't I take this trade? One more thing I want to show you. If you want a little bit more information, I'm going to click buy, and I execute. I just buy the instrument. This is not an option contract. It's a future contract. So the cost of the trade for me is 22.25, but it represents every point that one of these changes. So each tick, 96.08 to 0.85 is $20. 96.08 to 96.09 is 41, roughly 41.67. So each penny or each basis point move is worth $41 per contract. So if you had a 25 basis point move, that's roughly $1,200, right? Per contract. So it's not really a bad trade. If it drops and it goes drops 25 basis points because the Fed only cuts once, it's a $1,200 loss. But again, I've showed the data that I don't think it's going to drop. I will at least get 2 cuts. If I get 3 cuts, then I win. And that's kind of where my head is at right now. So this is simply just buy and hold. There is no optionality to this. It is a buy and hold and just wait for news to come in, jobs to drop more than they expect, something happen geopolitically, and you just sit and wait. You don't lose with time decay or anything like that with options. One more thing, if you want a little bit more insight into this contract, I'm going to show you where you can find futures contract information. If you go click on the CME Group website and you click markets, click interest rates, scroll down, you trade all sorts of interest rates. There's the treasuries. I can buy a 2-year contract, a 5-year contract, 10-year contract. This represents different sizes of bonds. This would be a $100,000 bond. This is a $200,000 bond, and I can hold these contracts for a lot less money than spending $200,000. The margin requirements are very low, but you're highly leveraged. So going down to the Fed funds rate, here it is. I can trade this contract. Click on this, and I go over to specs. And here you go. This is where you can find information about when it settles, prices, what it represents. And so each half basis point is $20 per contract. So 1 basis point change is $41. So not a bad little investment if you believe that rates are going down. Again, this is not financial advice. This is for education. This is what I'm doing. Do your own research, and good luck. Thanks.